Welcome back to the Deep Dive. Today is Friday, January 30th, 2026. And I want to start today by asking you to picture a number in your head.
Okay.
It's a number that usually sends institutional investors running for the hills, screaming. $1.02.
The dreaded penny stock threshold. It's a psychological barrier as much as it is a financial one.
Exactly. That is where Offerpad, ticker symbol OPAD, is trading as we speak. We are looking at a market capitalization hovering just under $50 million.
50. With an M.
With an M. Now, if you didn't know the history here, if you just opened a terminal and saw those numbers, you would probably glance at it and say, okay, another failed microcap next. You wouldn't give it a second thought.
No, you'd filter it out immediately.
But here's the thing that makes this story stick in your throat. This is a company that has transacted billions of dollars in revenue. It was, for a brief, shining moment, the darling of the PropTech revolution.
It absolutely was.
It was supposed to change how everyone in America sold their house.
It's a massive disconnect, isn't it? You have a company that, even in a terrible year, is moving nearly $1 billion through its books, yet the market is valuing the entire enterprise for less than the cost of a high-end apartment complex in Manhattan.
That's a great way to put it.
You could literally buy a penthouse on 57th Street for more than the market thinks this entire company is worth. It's kind of staggering when you frame it like that.
So that is the tension we are sitting with today. We have a massive stack of documents on the table. We are looking at the 2024 annual report, the earnings transcripts from every single quarter of 2025, and some very painful, very recent 8K filings from just a few weeks ago in January 2026.
Yep.
And we're going to try to answer the $1 question. Is this a falling knife that investors should avoid because it is going to zero? Or is this, as some contrarian analysts are whispering, a coiled spring?
It's the classic distressed asset dilemma. But to understand if it is a coiled spring, meaning something that's, compressed and ready to explode upwards, you have to understand that the Offerpad of 2026 is not the Offerpad of 2021.
It's a different animal.
A completely different animal. If you still think this is just a house-flipping company, you are looking at the wrong business model. You are looking at a ghost. They are attempting a massive pivot to something they call real estate as a service.
REAS. I love a good acronym. It sounds very sauce, very tech-forward.
It is intended to be. And honestly, if they pull it off, that $50 million valuation is going to look absurdly, laughably low in hindsight.
But that's a big if.
It's a huge if, but if they fail, well, the liquidity runway is short. The walls are closing in.
The clock is ticking loud. So here's our mission for this deep dive. We're going to tear apart the financials, the good, the bad, and the ugly. We're going to dissect this asset-light pivot to see if it's actually real or just corporate speak.
Right. Is it real or is it a buzzword?
And we are going to talk about the macro environment, the frozen housing market, that is holding all of this hostage. Because ultimately, this is an analytical stock discussion. We need to be objective, factual, and logical to answer. Would you buy this stock today?
Let's open the hood.
I want to start with the identity crisis. For years, Offerpad was synonymous with iBuying, instant buying. The pitch was incredibly seductive.
Oh, it was brilliant marketing.
You type in your address, an algorithm spits out a number, they buy your house.
Cash.
Close in 10 days. Simple.
It was simple, and it was revolutionary for the consumer. It solved the biggest pain point in real estate, which is uncertainty.
Right.
If you've ever sold a house the traditional way, you know the drill. You clean up, you hide the dog, you leave for open houses, you get an offer, the buyer's financing falls through, you start over. It is a nightmare.
It's unbelievably stressful.
Offerpad said, we will take that risk for you, for a fee, of course.
But taking that risk is expensive.
Oh.
And it turns out it's dangerous.
It is incredibly capital intensive. Think of it like a grocery store. This is the best analogy to understand the flaw in the original model. A grocery store has to buy the apples from the farmer before they can sell them to you.
They own the inventory.
They own the inventory. They have to pay for the trucks, the refrigeration, the shelf space. If the apples rot, the grocery store loses money.
Okay.
If the price of apples crashes while they are sitting on the shelf, the grocery store loses money.
And in the housing market of 2023, 2024, and 2025, the apples, the houses, didn't necessarily rot, but they became incredibly expensive to hold.
Interest rates. That is the killer. That's the whole story right there.
Yeah.
When you borrow money at 2% to buy a house, you can afford to sit on it for a few months while you paint it.
Your carrying costs are low.
Super low.
Oh.
But when you are borrowing at 7% or 8%, which is the reality of the last 2 years, Every single day that house sits empty, it is burning a hole in your balance sheet. It is eating your margin alive.
So looking at the 2024 and 2025 financials,
Hmm.
we see this massive drop in revenue. I'm seeing year-over-year drops of 30%, sometimes 44% in a single quarter.
Yeah, the numbers are jarring.
Normally, when I see a growth company shrink by 40%, I assume the product is broken. I assume customers hate it.
And that's a totally rational assumption.
Yeah.
But in this case, the shrinkage was a survival tactic. It was voluntary.
What do you mean?
Management looked at the interest rate environment and said, if we keep buying houses at our old volume, the interest payments will bankrupt us. It was that simple. So they tightened the buy box.
That's industry speak for what?
For the criteria they used to purchase a home. They basically said, we're only buying 3-bedroom, 2-bath ranches in these 5 zip codes that we know we can sell in 30 days. They stopped buying anything that wasn't a guaranteed slam dunk.
So they chose to shrink to survive.
They chose to shrink to survive. They basically stopped restocking the shelves with risky apples.
But here's the problem with shrinking. You can't shrink your way to growth. You can shrink your way to survival, maybe, but eventually you wither away.
Yeah.
You have to pivot.
Yes.
And this is where the asset-light strategy comes in. This phrase is plastered all over their investor decks, like a mantra. Asset-light. Let's unpack that. What does it actually mean for a company that buys houses?
Asset light is Wall Street speak for making money without using our own balance sheet. It's about shifting the risk.
Okay.
They want to stop being the grocery store that owns the apples and start being the logistics company that just drives the truck.
I like that.
A logistics company doesn't care if apple prices go up or down. They just get paid a fee per mile to move them from the farm to the store.
The logistics metaphor is interesting. So they are moving from a trading business to a service business. Who are they driving the truck for?
Everyone else. This is the exciting part. The most exciting part of this pivot, and the part that I think the market is severely underappreciating because they are too focused on the stock price, is the renovate division.
This is the B2B side, the business-to-business stuff.
Correct. Think about it this way. Over the last decade, Offerpad built this massive machine to renovate their own homes. They have project managers. They have proprietary software that tracks the price of drywall and paint in real time.
A whole internal infrastructure.
A huge one.
Yeah.
They have relationships with flooring guys and roofers in 20 different markets. That is a huge sunk cost. It is infrastructure. It's a capability they built over years.
It's a capability. They built a factory to fix their own stuff.
Exactly. And then when the market turned, someone finally asked, wait a minute, we have this massive logistical capability. Why are we only using it for ourselves?
Right. Why not rent it out?
So they started going to banks, to single-family rental funds, to institutional investors who own hundreds, sometimes thousands of homes.
The big guys. The ones with the real money.
The big guys. And they said, hey, Mr. Bank, you just foreclosed on a portfolio of 50 homes in Atlanta. They are trashed. You are a bank. You don't know how to hire contractors. You don't want to manage 50 different painters. We will do it for you.
So Offerpad manages the renovation, but the bank pays for the materials and the labor. Offerpad's just the project manager.
Offerpad manages the logistics. They act as the general contractor. They get the house market ready. And they charge a fee for that service.
And here's the key.
Here's the magic. Offerpad never owns the house. They never pay a dime of interest. They never take market risk. If the housing market crashes tomorrow, Offerpad still gets paid for the renovation work they did.
That removes the biggest risk factor from the equation.
Completely, 100%. It decouples their profitability from the direction of home prices.
And the margins. That must be a better business.
That is the best part. When you flip a house, the old model, you are lucky to make 5% or 6% net margin after all the costs, if everything goes right.
So for every $100,000, you make $5,000.
Right. In the Renovate program, they are seeing gross margins in the 20% to 30% range.
That is a completely different business profile.
Completely.
That is a tech service profile, not a low-margin trading profile.
It is. And the growth is explosive. We're looking at the data here. In 2024, Renovate revenue hit $18 million, up nearly 50% year over year.
50% growth in a down market.
Exactly. By Q1 2025, they did over $5.3 million in a single quarter. Now, pause for a second. I know what you're thinking.
I'm thinking $5 million is nothing.
$5 million sounds tiny compared to the $1 billion in home sales they used to do.
It feels like a drop in the bucket on the top line. If they're doing $160 million in total revenue in a quarter, $5 million is, what, 3%?
On the revenue line, yes, it is small. But on the profit line, it is huge. Because that revenue is high margin. It flows almost directly to the bottom line to pay for overhead. It is quality revenue versus quantity revenue.
Okay, that's a key distinction.
It's the most important one.
It's almost like Amazon Web Services. I know everyone uses the AWS analogy, but it fits.
It really does.
Amazon built servers for themselves to run the store, then realized they could rent them out to Netflix and the CIA and make a fortune.
Offerpad built a renovation network for themselves, and now they are renting it out to Blackstone or whoever. That is the perfect analogy. It transforms a cost center into a profit center.
And it's not the only piece of this pivot.
No, it's not. And it's not just renovate. They have Direct Plus A, which is basically a matchmaking service.
A marketplace.
Essentially, they find a seller who wants cash, and they find a buyer, like a rental fund, who wants a house. Offerpad just makes the introduction and takes a fee.
So they're a broker.
A high-tech broker, again, no risk, no balance sheet, just a transaction fee, pure margin.
And then there's the agent partnership program. This one surprised me because traditionally, iBuyers and real estate agents were at war.
Oh, it was brutal.
It was sharks versus jets. Agents thought Offerpad was trying to steal their lunch and eliminate their jobs.
It was a war. For years. But Offerpad waved the white flag. Or maybe it was a strategic truce. They realized that real estate agents control the inventory.
They control the supply.
They do. Most people, when they want to sell, they don't go to a website first. They call their local agent, someone they trust.
Yeah.
So Offerpad went to the agents and said, look, bring us your client. If we buy the house, we will still pay you your full commission.
Wait, so the agent gets to look like a hero for finding a cash buyer instantly, avoids all the open house work, and still gets paid their 3%.
Exactly. It's a no-brainer for the agent. Why wouldn't you present that option to your client?
And for Offerpad, what do they get?
It lowers their CAC customer acquisition cost dramatically.
Ah, the marketing spend.
Right. Instead of spending millions on TV commercials and billboards trying to convince people to sell to them, they just let the agents bring the sellers to the door. It's a much more efficient channel.
And is that working? Do we see it in the numbers?
We do. In Q1 2025, the data shows something like 42% of their homes came from agents. That is up from 28% the prior year.
So nearly half their business is now coming through this channel.
That is huge efficiency.
So the strategy is clear. Shrink the risky, capital-heavy flipping business, grow the safe, high-margin service business, create a one-stop solution center where you can sell to them, list with them, or let them fix your house.
That's the vision.
It sounds great on paper. It sounds logical. But we have to look at the reality of the bank account, because strategies don't pay the bills. Cash does. And right now, they are burning it.
Let's get into the financial health check. This is where the rubber meets the road.
We mentioned the revenue drop. Full year 2024 revenue was $919 million, down 30%. Q1 2025, down 44%. If you are a growth investor, these numbers make you physically ill.
If you're looking for top-line growth, you are in the wrong place. Stop looking. This is a turnaround story, not a growth story yet. The metric that matters right now isn't revenue, it's cash burn and the path to break beam.
So how much are they losing? Is the bleeding slowing down?
It is. Let's look at the trend line. In 2023, they lost $117.2 million.
Ouch.
A disaster. An absolute bloodbath. In 2024, they cut that loss to $62.2 million.
Okay, so they cut the bleeding in half. That is significant. That's not nothing.
It is. That's real progress. And if you look at the adjusted EBITDA, which is a better measure of operational cash flow, in Q2 2025, the loss was only $4.8 million.
Under $5 million.
They are inching closer and closer to that break-even line. They're losing money slower than before.
How do they do that? You don't cut losses by 50% just by being smarter. You do it by cutting costs.
It was brutal. We need to be clear about the human cost here.
Sure.
They cut annual operating expenses by $115 million over a 24-month period. That means massive layoffs. That means shutting down offices. That means cutting marketing budgets to the bone.
They took a hatchet to the P&L.
They did. They have leaned out the organization to a point where there is no fat left. They are running a billion-dollar revenue engine with a skeleton crew.
They are running on fumes and adrenaline. But does that mean they are profitable?
Not yet, and that is the problem. Being almost profitable is like being almost alive when you are drowning. You are still underwater.
Right. Close doesn't count.
Management has this North Star metric they keep talking about in the earnings calls. They say they need to sell 1,000 homes per quarter.
1,000 homes. Why that number specifically? What's the magic there?
Their modeling suggests that at 1,000 homes sold per quarter, combined with the growth in the high-margin renovate business, they hit adjusted EBITDA break-even. That is the magic number where they stop burning cash from operations.
That's where they can breathe.
That's where they survive.
And where are they now? What was the last count?
In Q2 2025, they sold about 452 homes.
Oof. So they need to more than double their volume from where they are today.
Roughly, yes. And that is the terrifying part of the bull case. Doubling your volume in a housing market that is currently frozen, where transaction volumes are at 30-year lows, is a very tall order.
That sounds almost impossible.
It's like asking a surfer to catch a double overhead wave in a calm lake. The conditions just aren't there right now.
But they have this contribution margin lever. Can you explain that? Because the report highlights it heavily, and it seems to be their counter-argument to the low volume.
Okay, so contribution margin is basically the profit on the specific unit after you pay the interest and the selling costs. It's the unit economics.
So on each house they flip, how much do they make?
Exactly. And here's the kicker. In Q1 2025, over 40% of their contribution profit came from those asset-light services, renovate and direct, plus
Let me make sure I heard that right. Not revenue, profit.
profit. 40% of their actual profit is coming from the side businesses.
Wow.
Correct. Even though those businesses are a small slice of the revenue, they are generating almost half the profit. That proves the pivot is working. It's not just talk.
So it's real.
It's real. And if they can just scale that side of the business a little more, they become less dependent on flipping houses. They lower the break-even point. Maybe they don't need 1,000 homes. Maybe it's 800.
So the engine is efficient. The car is lighter. But do they have enough gas in the tank to reach the destination?
That's the question.
Because that brings us to the risks. And there's a big elephant-sized risk in the room.
The bear case. We have to talk about January 2026, just a few weeks ago.
The press release that made the stock tank. Offerpad announced an $18 million stock sale.
The dilution event. That's what the market calls it.
They sold shares at $1.80. Today the stock is at $102. Talk to me about why this happened and why the market hated it so much.
It's called a down round in spirit, even if it's public market dilution. When a company sells stock at these levels, it screams one thing: we need cash, and we need it now.
It's a sign of desperation.
It can be. You don't dilute your existing shareholders, cutting their slice of the pie smaller unless you absolutely have to.
Expensive money.
It's incredibly expensive money, and it signals to the market that the runway, the amount of time they have before they run out of cash, was getting uncomfortably short. It spooked investors. They thought, wait, I thought the turnaround was working. Why do you need an emergency infusion?
What is their liquidity position right now? How much cash is actually in the bank?
They report total liquidity around $75 million, but you have to be careful with that number. That isn't just cash in a checking account.
What else is in there?
That includes capacity on their credit lines, so money they could borrow to buy more homes.
So it's like counting the unused limit on your credit card as money you have.
Exactly. It's available, but you have to pay to use it, and it's not for paying salaries. The unrestricted cash portion is much lower, and when you are burning cash, even if it's only $5 million a quarter plus you have debt payments, $75 million isn't a fortress.
It's a buffer.
It's a buffer. It's a rainy day fund, and it's currently pouring rain.
So they bought themselves maybe a year with this stock sale.
Maybe 12 to 18 months if they execute perfectly. If the housing market gets worse, less. It is a race against the clock.
And that leads to the death spiral risk. If the stock price stays around $1, they face delisting from the New York Stock Exchange.
That is a technical risk, but a real one. The NYSE has rules. Rule 802.01b. You can't be a penny stock forever.
What happens if they get delisted?
It's bad. Institutional money can't touch them. Big mutual funds have charters that say we cannot buy stocks not listed on major exchanges. If they get kicked off, the buyers disappear. They end up on the pink sheets. Liquidity dries up. It's a disaster.
They could do a reverse stock split. Merge 10 shares into one to get the price up to $10.
They likely will. It's a common maneuver. But markets usually see a reverse split as a sign of weakness.
It's an admission of defeat, in a way.
It's cosmetic surgery, not a cure. It fixes the price, but it doesn't fix the business.
There is also the debt. They carry secured credit facilities. What happens if home prices drop 10% tomorrow?
That is the nightmare scenario. That's the Zillow scenario.
Explain that.
Those credit facilities are secured by the homes they own. If the value of the homes drops below a certain threshold, the banks can issue a margin call. They can demand Offerpad put up more cash to cover the difference.
Cash they don't have.
Right. That is what killed iBuying for Zillow. It wasn't that the idea was bad. It was that the asset values dropped too fast and the balance sheet imploded.
Is Offerpad in the same boat?
Offerpad is much more disciplined than Zillow was. They are better at valuation, their buy box is tighter, but the systemic risk is still there. If housing crashes, the debt becomes toxic.
So if you're holding this stock, let's be clear about what you are betting on. You are betting that A, they won't run out of cash, B, they won't get delisted, and C, the housing market won't crash. That is a lot of ifs.
It is a high wire act. There is no safety net. They are walking across the Grand Canyon on a dental floss.
And here is the pivot in our conversation. If they don't fall off the wire, the upside is potentially massive. And that brings us to the coiled spring theory. This is the argument that keeps the bulls holding on.
This is the macro bet. This is where you zoom out. Forget Offerpad specifically for a second. Look at the U.S. housing market.
What do you see?
We are currently seeing transaction volumes, the number of houses selling at levels comparable to the great financial crisis of 2008.
It's a ghost town out there. Realtors are driving Ubers because nobody is selling.
But the reasons are different, and this is so important. In 2008, nobody could buy because they were broke and banks weren't lending. In 2026, nobody wants to sell because of the lock-in effect.
The golden handcuffs of a 3% mortgage.
Exactly. You have millions of Americans sitting on 3% mortgages from the pandemic era. They want to move. They hate their house. They've had kids. They have changed jobs. They need more space.
Life happens.
Life happens. But they look at the math and refuse to trade a 3% rate for a 7% rate. It would double their monthly payment.
So demand isn't gone. It's just suppressed. It's holding its breath.
Precisely. It is compressed energy. We call them the 5 Ds of real estate: diapers, diamonds, divorce, death, and debt.
It's grim but memorable.
Those are the things that force people to move, and those things happen regardless of what the Federal Reserve does. People still get married, have babies, get divorced, and pass away.
You can only delay a divorce for so long because of interest rates. Eventually, you have to sell the house.
Exactly, and that creates a backlog. 2 years of backlog. That is the spring uncoiling. Management is predicting, and broader economic data supports this, a 15% to 20% increase in transaction volume in 2026 if rates stabilize even slightly.
Even if they just stop going up.
Even if they just go sideways. And if that spring snaps back,
Offerpad is sitting there, leaner than ever, ready to catch it.
that is the concept of operating leverage. Imagine Offerpad is a factory. They just fired half the workers and shut down half the lights to save money, but the machinery is still there.
Okay.
Suddenly, orders double. They can turn the machines back on without hiring all those people back immediately. Their fixed costs stay low, but their revenue explodes.
So if volume returns to, say, 2022 levels, but they are operating with 2025 expenses.
They aren't just profitable, they are printing money.
Wow.
The profit expansion would be violent in a good way.
Yeah.
And they have the tech to handle the speed. Their pricing tool, Citrus Value, I know it sounds like a smoothie shop, but it is actually a very sophisticated AI, allows them to price thousands of homes instantly.
Why does speed matter?
In a volatile market, he who prices fastest wins. Traditional brokerages are slow. They need to run comps, drive by the house, have a meeting. Offerpad can make an offer in 24 hours.
So they can capture that new demand faster.
If the market unfreezes, that speed allows them to capture market share before the traditional guys even wake up.
So the bet is not just on Offerpad. The bet is on the American homeowner eventually needing to move, and Offerpad being the bucket that catches that demand.
Correct. It is a macro bet on the normalization of housing turnover with a high leverage vehicle.
We can't talk about Offerpad without acknowledging the 800-pound gorilla in the room. Opendoor, ticker OPEN.
The Goliath.
Opendoor is massive compared to Offerpad. They have always been the tech answer to real estate, the Amazon of homes. If I believe in the recovery, why buy the little guy, Offerpad, when I can buy the leader, Opendoor?
It's a philosophy difference, a really important one. Opendoor has historically been about volume and automation.
Scale at all costs.
Scale at all costs. They wanted to remove the human from the loop completely. Trust the algo. Offerpad, specifically under CEO Brian Baer, has always been about operational density and the ground game.
Brian Baer isn't a Silicon Valley tech bro, right? He comes from real estate.
No, he is a real estate guy. He started by flipping houses manually in Phoenix. He knows what dry rot smells like.
An important skill.
He knows that an algorithm can't tell you if a house smells like cat pee, and that matters.
The cat pee factor.
It sounds funny, but it's real. If you buy a house that smells, you lose money. Open Door's algorithms have historically struggled with those nuances, leading to them overpaying for bad homes.
So they bought the wrong houses.
They bought a lot of the wrong houses. Offerpad's data suggests they consistently achieve higher profit margins per home because they are better at the renovation execution. They don't just trust the computer, they trust the contractor. They have boots on the ground.
So Opendoor is a tech company trying to learn real estate. Offerpad is a real estate company using tech.
That's the distinction. I couldn't have said it better myself. And currently, the market valuations reflect that difference. Opendoor trades at a premium. Offerpad is trading at a deep discount relative to its revenue, like 0.1x price to sales.
That is dirt cheap.
It's absurdly cheap.
If they survive.
If they survive. But here is the interesting nuance. Opendoor is also struggling with profitability. But Offerpad's shift to high-margin B2B services, the renovate business we talked about, might make it a sneakier value play.
How so?
Opendoor does not have a massive B2B renovation arm like Offerpad does.
So Offerpad is a diversification hedge that Opendoor lacks.
Correct. If the housing market stays frozen, Offerpad can still make money fixing up houses for banks. Opendoor has to buy and sell houses to survive. Offerpad has a second lung to breathe with.
Okay, we have unpacked the model, the numbers, the risks, and the competition. Now comes the part where we have to synthesize this. Buy or pass. And I know we can't give financial advice, we aren't your fiduciary, but we could build the profiles.
Let's start with the checklist. We said we would be objective. Is the pivot logical?
Yes, I think we agree on that.
Yeah.
Moving to fee-based services reduces risk and utilizes their core strength. Makes total sense.
Factual. Are they profitable yet?
No. That is a factual no. The losses are narrowing.
Okay. Financial. Do they have a lot of cash?
No.
No.
The runway is finite. That's the biggest red flag.
Yeah.
But is the upside high if they pull it off?
Yes. Very high.
Okay. So with that framework...
Let's look at the profiles. If I am a conservative investor, if I am managing my grandmother's retirement fund, if I want steady growth and dividends...
You run away from this.
Yeah.
You don't just walk, you sprint. This is a micro-cap stock in a highly volatile sector with a questionable balance sheet.
Too much uncertainty.
Way too much. The dependency on interest rates dropping is too high. The dilution risk is too real. This is not an investment for money you cannot afford to lose. Full stop.
Okay, understood.
Yeah.
But if I am a speculator, if I am the high-risk, high-reward type, if I'm looking for a distressed asset that the market has left for dead, then this is fascinating. This is where you lean in. You are buying a company for $50 million that has the infrastructure to generate billions.
You're buying the infrastructure for pennies on the dollar.
You are buying a call option on the U.S. housing market recovery. That's what this is.
What is the upside potential? Paint the picture.
Some analysts have price targets around $3.50. From $1.02, that is a 200% to 250% return.
A three-bagger, potentially?
And that's just a starting point. If the coiled spring pops in late 2026 and Offerpad captures that volume with their new lean cost structure, the stock could re-rate significantly higher than that.
It's an asymmetric bet. The downside is it goes to zero. You lose 100% of your money. The upside is it goes to $3 or $4. You make 300%.
Exactly. But you have to believe two things, and you have to believe them strongly. One, the housing market will unfreeze. And two, Offerpad has enough cash to survive until it does.
It really comes down to that race. Can they execute that 1,000 homes per quarter target before the bank account hits zero?
That is the metric. If you are listening to this and you are thinking about buying OPAD, you need to watch the next earnings report like a hawk.
What are you looking for?
Ignore the top-line revenue number. It doesn't matter yet. Look at two things. Did they hit the homes sold target? And did the renovate revenue grow?
The heartbeat of the new Offerpad.
Renovate is the life raft. If that grows, they survive. If that stalls, they are in trouble. It's that simple.
You know, as we wrap this up, I'm struck by a thought. We keep calling Offerpad a real estate company, but listening to you describe the renovate program and the logistics, Offerpad isn't really a real estate company anymore.
What are they?
They are a logistics company for the housing market. They move things, they fix things, they connect people. Their asset isn't the houses. It's the network they built to process the houses.
That is a profound way to look at it, and I think it's right.
And if the housing market is frozen, logistics don't matter. Nobody needs a truck if nothing is moving. But if the market moves, logistics are everything.
That is the crux of it. In a gold rush, you want to be the one selling the shovels. Offerpad is trying to stop digging for gold and start selling the shovels, renovations, partnerships, direct connections.
The question isn't just will Offerpad survive? It is, will the housing market unfreeze before Offerpad runs out of runway? It's a game of chicken between Brian Baer and the Federal Reserve.
And right now, the Federal Reserve is holding the cards. But Brian Baer is playing a very scrappy hand.
Well, looking at the clock, that's about all the time we have for today. We have torn apart the 10K, scrutinized the strategy, and looked the dilution in the eye.
It's definitely not a boring stock.
For all of you listening, keep an eye on that renovate revenue line item in the next report. That is the signal in the noise.